Welcome to the lecture on types of life insurance policies. So, we had the introduction about the life insurance in the earlier lecture, and we also had started discussion about the types of life insurance policies in that. And as we knew in that lecture that there are basically three types of life insurance policies. One is the whole life insurance policy, second is the term insurance policy, and third is the endowment policy. So, we talked about the whole life insurance policies in that basically you can have the net single premium, or you can have the annual premium. You can also go for the deferred whole life premium, then whole life policy. You can have the deferred annual premium and also the deferred annual premium on M payment basis. So, all these are the examples of the whole life policy. So, for that the premium calculation, as we know that if you are for the whole life insurance policy. So, for that as we knew, we had seen how to derive, and we had derived also so when we are interested to find the net single premium. So, that was AX, calculation of the AX, and if F is the face value. So, for face value of F so AX will be F into MX upon DX. So, that was the whole for the whole life insurance policy. Now, what happens that when there will be annual premium. So, this is the single premium, and for annual premium so for annual premium means many a times the net single premium amount is quite high for certain face value. So, in that case the person who is insured he wants to pay annually. So, in that case the amount which is calculated will be Px, and that will be for face value F, it will be Mx by Nx. So, that is what we had also seen, that how to find it, because in that case Ax will be Px into A double dot x, small a double dot x. So, based on that we calculated the value of Px as F into Mx by Nx. Then many a times if we are doing for the annual premium for M payment basis. So, annual premium and for M payment basis. So, in that case the premium amount, so we call it as MPX, and this comes as for face value of F, it will be Mx divided by Nx minus N of x plus M. So, this way you can calculate the annual premium for the M payment basis. Now, if you want to defer the whole life policy, so for the net single premium, so for the deferred whole life policy, so if you go for the net single premium, that will be, it is known as NAX, deferment period is N. So, that way it is denoted as NAX, and it is basically F into Mx plus N divided by dx. So, that is what if you look at here, it is ax equal to f into mx by dx. Here it becomes nax, that is for the deferment period n, it will be nax equal to f into m into x plus n by dx. Now if you find the deferred annual premium, and so this is for the whole life policy, and you can go for the deferred annual premium, and that is for the whole life basis. So you can calculate that deferred annual premium. So deferred annual premium for whole life basis. Now in that case this becomes equal to f into m of x plus n divided by nx. So that is for annual premium, it is in the denominator, it is nx. So it will be f into m of x plus n divided by nx. So that is what it will be written as, and it will be f of mx plus n and divided by, since it is nx here, so it will be nx. So this is the deferred annual premium for the whole life basis. And the next one which remains to be seen will be the deferred annual premium for the m payment basis. So if you find the deferred annual premium for m payment basis, you are only paying m times. So in that case we denote as mp, and then we call it as nax. So this is by for the deferment of this is deferred annual payment, but only for m payments only. So in that case in the same way it was here, if you look at the deferred payment, so it will be again m f of m of x plus n and divided by nx minus n of x plus m. So that way as you see here, so it is similar to this, it will be mx, and since it is for that deferment annual period, so it will be for f of m x plus n divided by nx minus n of x plus m. So these are the formulas which are used for the whole life insurance cases. Now the next type of insurance policy is the term insurance policy. Now what is this term insurance policy? So now if the survivor is or if the person who has insured, now in this case the face value of the policy will be paid to the survivor only if he is alive during that term of the policy, that is n. So that is what the term insurance policy tells, and here also again you can have the net single premium, or you can have the annual premium or so. So n is here the term of the policy, and during that the person has to be survived, he has to survive, and if not, then he will be paid the face value of the policy. So if he dies, then only he will be paid that face value of the policy. Now in this case again you will be calculating the values of the premium amount, and it may be again in the similar line for the single premium, or for the annual premium, or for the deferment period or so. So when we talk about the net single premium, so net single premium in the case of term insurance, So in that case we denote it as A1 and then we call it as xn. So this is known as, this is the notation for the term insurance policy, and this is A, that is the single net single premium. Now this will be nothing but it will be the difference of the, so it will be difference of cost of whole life insurance that is AX and deferred whole life insurance that is NAX. So this can be viewed as the premium which is paid for the cost of the whole life insurance, in which you pay once, and then if you are deferring because up to that if you are alive then you are not paid. So it will be as per the deferred whole life insurance. So it is something like you are going to pay after that period. So up to that you are anyway alive. So in that case this will be the difference of the two values. So you can write xm, and that is for the so this is n basically. So you can write a x n, and that will be this. So it will be basically ax and minus nax. So we have already got the expressions for the cost of whole life insurance, that is your mx upon dx, and similarly the cost of the deferred whole life insurance. So that will be mx plus n by ds. It's basically deferred by that period term of the term policy years n. So it will be mx upon dx, and then it will be divided by mx plus n by dx. So it will be mx minus mx plus n by dx. So this is for the on the basis of single dollar, and if you try to find it for the face value f. So for face value f you can write it as mx minus, so f times mx minus mx plus n and divided by dx. So this will be your the value of the net single premium for the term insurance policy. So this can be computed by referring to the table, and if suppose somebody wants to suppose for example if a person wishes to buy a 13-year term insurance. So for example suppose a person to buy a 13-year term insurance policy of 50,000 suppose dollars. So at age of 57, so this a person is of age 57 and he wants to have a 13-year term insurance policy of $50,000. Now in that case how much the net single premium it should be. So net single premium should be how much. Now in that case if you find the a xn, and that is that will be f, so that is 50,000, and then you have to multiply with the factor that will be mx. So mx will be m57 minus mx plus n, so that is 57 plus 13, that is 70, and then divided by you have to do dx, so d57. So you can get these values from the table, and so for 57 you can see for 57 the mx values. So it will be something like 2014, So that way yes 2014.22, and for 70 it will be 1222.70. So that way, and then again you can find the dx d57, so it will be 5372.84. So this value can be used, and then you can calculate these values. So it will be 50,000 multiplied by 2014.22 minus 1222.70 divided by 5372.84. So if you do that, you will get 7365.94. So this way you can find these net single premium values. Now in the case of term insurance policies, you can go for k number of payments, and k should be less than or equal to n. So when you are going for annual payments, so for annual payments with number of payment equal to k. So k has to be less than or equal to n. So if you want to calculate for suppose k payments, in that case annual premium will be calculated as, and it will be called as it will be denoted as k into p x n, and so this will be that, and this will be calculated as f into mx minus mx plus n divided by nx minus nx plus k. So this way this can be you can find these expressions, and these values can be used for the for annual payment when you have to make only k payments, and k has to be anyway maximum k value can be going to n. So that way you can get the values. Then this is there is another case of the deferred annual premium also for the whole life basis. So deferred for whole life basis. So we will discuss basically about before that we are going to discuss about the example of the case where the person suppose wants to go for the same payment. So for the same problem, if a person wants to pay in only 10 installments say, so in that case what will be the net single premium, and that can be computed for these insurance policies. So suppose the person is for the same person, if the person wants to pay it off in 10 terms. Now how this how this can be computed. So for that what you will do is you are going to calculate again k into p x n. So that will be k is basically 10. Now that will be equal to f into mx minus mx plus n divided by nx minus nx plus k. So again you are going to use, so n is 15 and k is 10. So you are going to calculate this 50,000, and then you will have m57 and m70 divided by n57 minus this 57 plus 10. So it will be n67. So this again you can use from this table, and you can calculate these values, and it comes out to be 959.21. So if he has to pay in one go, it will be 7365.94, but if he has to pay in 10 terms, in that case he has to pay for 959.21. So that way he can find all these installment values or the premium values for the term insurance. Now, this is about the term insurance. We have anyway discussed about the deferred annual premium for the whole life basis, and now we will discuss about the endowment insurance policy. So, we talked about the pure endowment cases, and for the endowment insurance policy, in this case you will be having this will be sum of. So, basically the net single premium. So, in this case you are getting both the benefits if you are so be getting the benefit of term insurance policy as well as. So, I mean the life insurance this life insurance and also the pure endowment. Endowment was the one which we discussed earlier. So, in this case you are getting the benefit of both the whole life insurance as well as the endowment deposit. So, it will be in this case the net single premium of endowment, it will be basically. So, endowment insurance policy, and this is basically denoted by AXN. So, and we put it under the so this will be 1. So, this will be equal to. So, in that case it will be sum of net single premium for n term life insurance. So, that will be A1x n. So, and then net single premium for n term pure endowment. So, basically it will be because here you are in the case of pure term insurance you are not getting anything. Now, in this case you are getting both the benefits. So, you are what you do get is A x n. So, that will be and plus you have n e x. So, that is your pure endowment, and that is how you calculate the net single premium for these endowment insurance policies. And if you if you are calculating for the face value of f. So, it will be basically if you simplify it will be f into mx minus mx plus n plus dx plus n and divided by dx. So, if you have all the data you can directly compute the net single premium for the endowment insurance policy. Now, while after discussing this we also need to know something about the natural premium versus the level premium. Now, what is this natural premium and what is the level premium? So, natural premium. Now, this natural premium is basically the it is the single net single premium for a 1 year life term life insurance. So, it means that the policy will say that if the insured person dies within a year, then it will be paying the face value to the insured. So, that way that is the the natural premium. So, such a premium you can obtain by adjusting the regular term life insurance formula by making n equal to 1. So, if you take n equal to 1 in that regular term life insurance formula, if you put your n equal to 1, that way it will be for the natural premium. So, natural premium will be denoted by NA. So, not A, this NA, and this is XN. So, this will be so n will be 1 basically in this case. Now, in this case, so it will be mx minus mx plus n. So, it was x plus 1 by d. So, basically it becomes Cx by d. So, for face value d f, for face value f, it will be it will be equal to, so n a1 x 1, it will be f into Cx by d. So, that is your natural premium. Now, what happens that so this is your now the thing is that as the age increases, this value basically will be going on increasing a lot. So, what happens that as the age increases, the Cx value will be go on increasing and the d value goes on decreasing. That can be seen from the table, that the Cx value is basically increasing is on that way, and then so no, and so this is, and d value will be decreasing. So, in that case this premium value will go on increasing a lot. So, in that case what you do is that you take one value which is basically which will be compensating in the initial part. So, it will be taking initially more, and then later on it will be less. So, that way that will be known as the taking the face value. So, so this way we calculate the face value, or that is the level premium. So, this is natural premium, and in that case that will be your level premium. So, the justification is that as age increases, so this Cx will increase and d will decrease. So, that is why the natural premium amount will be going on increasing, and it will not be it will no longer be affordable. So, what we do is we depend upon the affordable premium, that is we try to give the regular annual premium. So, we try to manage by paying regular annual premium, which basically will cover. So, and that will be known as the level premium. So, this is known as the level premium. Now, this level premium policies, so they have a higher premium. So, these level premium policies which are used, in those cases it will try to see that it does not reach so high as the age increases. So, in that case what it does is it will be it has a high premium, so it has a high premium than natural premium in early years, and so it will be making you some giving you some excess fund, so that that will be compensating in the later years. So, and lower premium in later years. So, that way you calculate these level premium, and level premium basically will be calculated. So, if you try to calculate the level premium, the level premium is calculated as NPX. So, that will be f of mx minus mx plus n divided by nx minus nx plus n. So, that way for suppose a 15-year term insurance policy, and if it is 1 lakh is issued to a 50-year-old, in that case if you calculate these level premium and the natural premium. So, if you try to calculate the value, and if you try to find the graph, what happens, the graph comes like so this will be your level premium that will be calculated, that will be a fixed amount, and natural premium basically initially it will be less, but it will be increasing slowly. So, this will be graph for the natural premium, and this is the level premium. So, in the initial time, so what happens that it will be taking the larger amount, and that will be covered in the later years. So, that way this concept of the natural premium and the level premium is used in the case of the insurance sectors. So, that is how you calculate these premium values. Thank you very much.